the last one I thought I'd touch on is your overtime pay. So once again, he's gonna give you a certain amount. The bill says up to 12,500 of overtime hours you won't pay any income tax on. And the same phase out limits. Do you guys have any questions so far, just on of the basics? Okay. Tax credits. What's the cool thing about tax credits? They work different than a deduction because deductions reduce your income that you're reporting. Credits say we're just going to take it right off the taxes you owe. So we love tax credits. They can be substantial to people because a lot of times they're even refundable. Meaning if you qualify for a tax credit and your taxes aren't over the amount, so let's say you owe $2,000 in tax credits, but you have multiple children that you receive the new $2,200 tax credit of, you can actually get a refund from the government even though you didn't owe the taxes on that amount. So tax credits are much more generous. And like I said, with kids right now, they've increased the tax credit amount to $2,200. That's for kids under age 16. I believe you should get it for kids up to 26 because that's how old my kids still are. And I still pay for things for them. But what happens when you retire that you might not think about? You tend to lose a lot of the tax credits you were maybe receiving when you were working. And you might, if you owned a business, not have those same deductions because you would sell the business or you would start maybe just working as a consultant now, trying to get out of that lifestyle. So a lot of times with retirees, they don't think about all the different deductions or credits that they were taking advantage of. And so sometimes taxes can kind of worry them on that first year, trying to figure out, wait a minute, how did this increase so much? So what I like to talk about here is there are ways for you to stop volunteering to pay taxes. And there's two income streams that we volunteer for, in some ways just don't understand well enough. So we end up paying taxes on Social Security income and on long-term capital gains income. And unfortunately, what happens is, if you report enough income to the government, even $1 over the amount, you now are going to have these income streams taxed. So, long-term capital gains. This, like I said, is, if do any of you have brokerage accounts?
Not yet.
Right? Okay. When you pull money from a brokerage account, from a managed account, that income isn't ordinary income. It is more than likely going to be long-term capital gains income. And it gets taxed at its own rate. Also, if you sell assets, if you sell property, you sell land, all these things are going to have gain, and the gain is going to be long-term capital gain. And it's going to be taxed at this other amount versus ordinary income. The interesting part about how this tax rate works is, what do you want? Should I do an example on married or on singles? Married. Okay. So if we do a married couple, it would mean that if you pulled money from your brokerage account or from your managed account in order to use it as retirement income, let's say, you could pull up to $96,700 and not have it be taxed at all. If that was ordinary income, right, from maybe pensions or IRAs or things like that, we would be in a tax rate of probably around 15-20%. So what's nice about this is they're giving you a little bit of leeway. The trick is, this isn't just your long-term capital gains income that fills this bucket. At first, you have to say to yourself, what was my ordinary income? If my ordinary income was $50,000, let's say from a part-time job, that $50,000 just reduced that to now it's only $46,700 is left at the zero bracket. So what we want to do for yourself in retirement is to be able to say, how can I draw from income streams that don't get reported as income? That would be your 401k Roth, your Roth IRA, or cash value life insurance. Those three income streams are not reportable income. So I could, if I have a cash value life insurance policy, I could distribute from that policy $100,000 and still leave this whole bucket open so that when I pull money from my brokerage account, I'm in the zero bucket, right? So that's where sometimes we end up volunteering to pay tax, long-term capital gains tax, because we don't realize that ordinary income might shove us into the 15% tax rate automatically when we start taking those funds. So Social Security, like I said, is another one. Social Security has its own calculation. We can't keep this simple, right? We have to make sure that we keep all the CPAs in business. So Social Security says, we're gonna look not at your ordinary income, we're gonna look at your provisional income, whole new term. Provisional income is pretty much all income streams except for, the three things: Roth IRAs, Roth 401ks, and cash value life insurance. So when Social Security decides when they're going to tax your benefits, they have their own chart. And they say a married couple can have provisional income up to $32,000, and this has not changed for a number of years. This chart pretty much increases the money amounts every year with inflation. But Social Security, for some reason, this one has stayed consistent. They make it easy for me to remember. With this, once again, if you were pulling money from your Roth IRA, nothing is met here yet. It's not part of provisional income. So it would assume that you get 0% of your Social Security income taxed. But once I start reporting my traditional IRA, my pension, those different income streams, you start building up. And it's going to be a percentage of your Social Security benefit that now counts as income and gets included in part of your effective marginal tax rate. For that Social Security calculation to figure out where you fall here, 32,000 and then up to over 44, they look at your adjusted gross income. They add back in if you have muni bonds. Muni bonds don't have any federal tax that's owed, but they actually put the income back into this calculation. And then as a married couple, if you received $50,000 a year in Social Security benefits, they would put that here and only use half of it, 25. But that would be your total for provisional income. Not to get into the weeds too much, but once again, these income streams currently, you could receive as much as you wanted, and you would not impact the taxation of your Social Security benefits. Unfortunately, all those other assets there, they look at and every year calculate in order to determine how much of your benefits will be taxable. So if you could get all your income from these, you would keep your Social Security income completely tax-free as well.